Thanks, Dan. What I'd like to do first is just talk to a little bit about a managed account service and what it actually is. Essentially, regardless of whether it's operated under an MDA service or within a managed investment scheme, a managed account service is a service whereby an advisor is given autonomy by the client to manage the client's portfolio of investments. The autonomy is not absolute because the parties agree in advance an investment program, which can be as detailed or as broad as they seek to agree, but generally speaking, it sets out how the advisor or investment manager will invest the client's assets, what types of assets they will invest in, sometimes what the asset allocation will be, and it gives generally the advisor or investment manager the discretion to be able to vary the investments and various aspects of the mandate in accordance with the prevailing market conditions in order to be able to achieve the client's goal. And then the third key element of a managed account service, which makes it different to a managed investment scheme, is that there is no pooling. In other words, every client holds the individual legal or beneficial title to their assets. What do we mean by that? Well, if the client's assets are in their own name, they'll hold the legal title, whereas if they're held by a custodian on behalf of the client, the custodian holds the legal title and the client has what we call a beneficial or equitable right to those underlying assets. So rather than the client contributing money into a pool, which the investment manager then invests at their discretion, the client can at all times identify exactly what the assets are that are being managed for them. And one of the benefits of that, of course, is that the taxation implications of any investment decisions flow directly through to the client as opposed to residing within the managed investment scheme. So let's have a look at the various components of a managed account. The first component is personal advice. This is where a financial advisor advises a client to invest their assets into a managed account service. So the advisor will say to the client, we think it's appropriate for you to have your assets managed on a discretionary basis for whatever reason that is individual to that particular client. Perhaps they don't have the time to manage their own assets. Perhaps they are going to be away and they want to make sure their assets are being actively managed when they don't have the opportunity to make a contribution or provide instructions in relation to their assets. There can be many reasons as to why it's suitable for the clients to have their assets managed on a discretionary basis. The second component is, of course, that then an investment manager, which can be the advisor, but more increasingly over time tends to be a professional investment manager, and I should say that's the way ASIC likes it to be. So an investment manager will recommend the investments in which the client should invest. And generally these days we see that being a range of model portfolios, mostly for efficiency, but for both the investment manager and the advisor, but also because the model portfolios can have a proven track record. So then behind the scenes, you have administration and reporting, whereby the administrator will buy and sell the investment in accordance with the investment manager's requirements, and then will report to the client periodically on performance. And of course, depending on whether the clients are held by the investments are held by the client directly, or whether they're held by a custodian, you may have an asset holding service. What we want to do today is talk about the fact that there are two key managed account structures. And they're called managed discretionary accounts. Managed discretionary accounts are commonly known as an MDA service, whereas a managed account structure which sits within a managed investment scheme is often known and referred to as a separately managed account. The reality is they are identical, but this diagram, but they sit within different structures. So what this diagram does is that it illustrates the structure. Where someone is providing an MDA service, there are two methods by which they can be provided. In the middle section of our screen, we can see that you can have a full MDA service whereby an advisor who has an appropriate authorisation on their licence to provide MDA services which is regulated under a class order issued by ASIC back in 2004, and also there's a specific regulatory guide in relation to this. They can provide discretionary investment services to the client in relation to all of the client's investments, regardless of where they're held. There is a subset of that, which is what we call a limited MDA, and that arose in late 2004 as a result of a no-action position which ASIC issued by letter to IFSA, as it then was, and basically said that if an advisor is only managing assets that are held within a regulated platform, such as an IDPS platform, then they don't necessarily need to hold an MDA authorisation on their licence, but they do need to comply with most of the obligations that an MDA operator would need to comply with. Not all of the obligations, but most of them. And whilst these are separately managed accounts, because the assets that belong to the client are not pooled, they tend to be known as an MDA service, as opposed to what we see on the right-hand side of the screen, which is an MDA service which is offered through a managed investment scheme. So most managed investment schemes take clients' money and they pool it and they invest it. But a number of schemes have a separate part of the scheme where they apply the same investment expertise, but they offer the client a service where they will separately manage their investments for them within the MDA, within the managed investment scheme, and within a non-pooled structure. In other words, the client's assets are held beneficially on behalf of the client. They can be identified by the client. The taxation implications of those investments can also flow through to the client in certain circumstances, and the investment manager reports to the client on the performance of their individual assets as opposed to the performance of the fund as a whole. So there are two key ways to provide discretionary managed account services. As I alluded to earlier, there are very significant differences in the governance requirements that apply to these managed account services. If the advisor or provider is providing an MDA service, then they need to have a specific authorisation on their AFS licence, authorising them to issue interests in a managed investment scheme limited to MDA services. And why is it a managed investment scheme authorisation? Well, that's because ASIC still regards MDA services as being a subset, if you like, of a managed investment scheme. Alternatively, if the managed account service is being offered through a managed investment scheme, the scheme has to comply with all of the overarching obligations set out in Chapter 5C of the Corporations Act that apply to managed investment schemes. So that means their licence needs to have an authorisation to operate a managed investment scheme. They need to register the managed investment scheme with ASIC under Chapter 5C, and in order to do that, they'll need to appoint a public company to be a responsible entity and demonstrate to ASIC that they have a compliance plan and an independent a compliance committee containing 2 independent members. So you can see that the governance requirements for a managed investment scheme in terms of the establishment of the scheme are significantly higher. On the other hand, as we'll see shortly, the compliance or the governance requirements from the perspective of the advice which is provided to the clients are significantly lower. And I might actually just skip to that slide because I think that's a logical time to consider those just now. So looking at the advisor lens for managed accounts, what we can see is that there are a significant number of external issues that the advisor needs to consider. If we're looking at a simple managed discretionary account service, the advisor will need to have an authorisation on their AFS licence. Whereas to recommend even a managed investment scheme, the advisor will not need a special authorisation on their licence. I should say, however, that there is some controversy around this at the moment because I had some recent discussions with ASIC whereby we checked whether or not ASIC expects advisors to have who recommend MDA services to have an MDA authorisation, and by that I don't mean to issue them, but simply to recommend and arrange them. And ASIC indicated that they believe that that advisors do need that authorisation, but they recognise that most advisors don't actually have this. And they also recognise that there is a lack of clarity around it because, to be honest, ASIC hasn't given a great deal of guidance on this. So I expect that when ASIC provides the response to the consultation paper and gives us some guidance on how we expect managed MDA services to be regulated going forward, there will be some clarification around not only the authorisations that advisors need or MDA operators need when providing a full MDA service, but also the authorisations that advisors who recommend MDA services or even SMAs within managed investment schemes need to have. For an MDA service, you need a special FSG, and effectively that your FSGs need to contain a bunch of information about MDA services and how they operate and the risks associated with them. But when you provide advice on an SMA style MDA within a managed investment scheme, you don't need to have that additional information in your FSG. There are no PDSs, on the other hand, for managed discretionary account services, but of course there will always be a PDS for the SMA service within the MIS scheme. However, for an MDA operator, that is definitely counterbalanced by the other documentation that has to be managed with clients, because a client needs to have an MDA contract, and that's a contract whereby the MDA operator contracts to provide the discretionary management services and needs to promise to the client to do certain things, which include, for example, providing the services honestly, efficiently and fairly, which of course they already have to do, but also to always act honestly and to prioritise the client's interests over the MDA operator's interests. Now that will sound familiar to anybody who's done a recent study of best interest duty, and it's quite interesting because what we've seen is the standard advisor obligations to clients catch up with the obligations which were laid down in 2004 for MDA operators. Effectively, the standard for all advisors has come up to the standard which is always applied to MDA operators. So the MDA contract has to be signed by the client. It can be a separate contract or it can sit within a statement of advice. It's not a particularly long document, or it doesn't have to be a particularly long document, and there are templates readily available. In fact, the Fold has some templates available on our website. On the other hand, for a managed investment scheme, you don't need to have an MDA contract because the MDA contract is in effect in the product disclosure statement. Similarly, for an MDA service, you need to have an investment program, and that essentially sets out the basis and the manner in which the investments will be managed. The advisor has to give advice to the client that the investment program is suitable for the client and articulate why it's suitable for the client. And both the investment program and the advice in relation to it and the MDA contract can also be in a statement of advice if you wish, or alternatively they can be a separate document. Now again, that's not required for a managed investment scheme, the reason being that the investment program generally is the model portfolio, or which is often as an option in the PDS. So whilst it's not strictly required as a separate document, what we can see is that it still is something which is generally provided to the client, because it sets out the client generally won't enter into an SMA within a managed investment scheme unless they have an understanding of the way in which their investments are going to be managed. For an advisor recommending an MDA service, there is an additional, or providing an MDA service, there's a fairly significant additional PI requirement in that the advisor needs to have $5 million minimum PI insurance rather than the normal $2 million. So that's a fairly hefty additional cost, but there is no additional PI needed if the advisor recommends an SMA within a managed investment scheme. There are also quite considerable reporting obligations which apply to advisors and MDA operators. So the MDA operator must undergo an annual audit, and the auditor has to look at quite a number of things in relation to the operation of the MDA service. The advisor must provide their clients with a quarterly report on all transactions and assets and liabilities, as well as the revenue expenses which have been incurred in the management of the client's investments. Now, that report must be provided quarterly, or alternatively, if the advisor, an MDA operator, has the capacity to provide continuous electronic reporting, that can be done as a substitute. And There is also an annual report required, which basically needs to advise the client of all the transactions during the year. So it's a roll-up, in effect, of the quarterly reports. And during that annual report, the advisor needs to, or when sending that annual report, they also need to provide the client with a copy of the audit report on the MDA service. Now, these are obligations which sit with the MDA operator. And although we've said no, that it doesn't apply to an MIS, what we're really saying there is, well, an advisor recommending an MIS that contains a separately managed account is not going to have to comply with those reporting requirements because the MIS operator will do that. So I don't want anyone to be confused about the fact that those obligations don't apply to a managed investment scheme. They certainly do, but it will be the investment manager who will deal with them. Also, from an MDA operator's perspective, there is an additional requirement to report MDA breaches to ASIC that sits on top of the normal obligation to report significant breaches. But if there's a breach of the separately managed account, that's not something the advisor is going to have to report to ASIC because, of course, the investment manager will do that. So you can see that there are swings and roundabouts in terms of the decision for an advisor as to whether they will use an MDA service that operates outside an MIS, or they will recommend an SMA within an MIS. And shortly, Dan will come back to that and he'll look at that in terms of the ongoing disclosure requirements. But before he does that, what I'd like to do is just to talk a bit about FOFA and managed accounts, because it is quite odd that all of the key planks of FOFA have had implications for MDAs, but that given the increase in MDA activity, there's been very little discussion or published writing on this topic. But in the last 8 weeks or so, I have been approached by a number of clients for advice on this issue. So I guess it's time for somebody to actually lay down their views, and for what it's worth, here are mine. The key issue with best interest duty and MDAs is that advisors recommending MDAs must be able to demonstrate that the service is fit for its purpose. In other words, it's likely to achieve the client's goals and is likely to put the client in a better position. And then finally, of course, as we know, this exists already as part of the obligation of the MDA operator under the class order, but also, of course, now under FOFA, the MDA operator must prioritise the client's interests over the operator's interests. So the test for determining whether the advice or the service is likely to put the client in a better position is whether a reasonable advisor would believe that this is the case. And that has to be determined at the time the advice is given, not with the benefit of hindsight. And it's an objective test. It doesn't matter what the actual advisor or MDA operator believed. If a reasonable advisor at that time would think that the service is not in the client's interests, then the advisor may well not be able to demonstrate that they have complied with the best interest duty. So let's also look at the client priority rule. What this means is that advisors must place the client's interests ahead of their own and the interests of anyone else associated with them or who's authorised them to provide the advice. So that means it's no longer enough to disclose a conflict or get the client to consent to it. Advisors simply have to avoid conflict. So in practice, this means that advisors can't further their own or anyone else's interests when providing advice, other than the client, of course. This links into best interest duty and the reason why advisors might recommend an MDA service. You can't recommend a service such as an MDA service, which is effectively an in-house service, simply because it will create revenue for you or your licensee or a related party. Because being an in-house service, as part of the best interest duty, you need to be able to demonstrate that there's an additional benefit for the client. The client has to truly value the service. It's not enough for an advisor to suggest to the service that active management of their investments is something that they should value and assume that will be sufficient for the client to be in a better position. The client actually needs to truly value the service and need and want it as an alternative to the other types of ways that their investments could be managed. Now, MDA services are certainly seen as a way for advisors to provide additional value for their clients by offering a more closely tailored and actively managed investment strategy. But not all advisors can genuinely add value in this manner. So unless as an advisor you have a unique and specialist investment management expertise, you may need to question whether you can genuinely offer a better outcome than a professional investment manager. And that's probably why until the past few years, MDA services have been a relatively rare phenomenon. The province of high conviction advisors with investment management backgrounds or the ability to put together a suitably specialist investment management package that offers clients a better alternative to the traditional approved product list selection of managed investment schemes or direct shares administered through a platform. But since the introduction of the ban on conflicted remuneration that prevents product and platform providers paying not only commission but more significantly volume bonuses or profit shares unless they have informed client consent and direction, advisors have increasingly seen MDAs as a way to replace this type of top-up income. So the theory is that when offering an MDA service, the advisor provides two services for which they can charge fees: ongoing strategic financial planning advice of the more traditional kind, for which they charge an advisor service fee, and investment selection and active management, which has hitherto been the province of fund managers. And that's what they charge an investment management fee. In terms of the best interest duty, the question for advisors is the MDA service that they construct in the client's best interests? One thing is for sure, and that is that ASIC will scrutinise these offerings very carefully. ASIC have made it very clear that they don't believe that the average financial planner has the skills to provide investment management services, and they expect this aspect of the MDA service to be provided by a suitably qualified investment management professionals. So advisors who don't incorporate this type of expertise into their MDA service offering are likely to be the subject of adverse regulator scrutiny. Now, of course, that creates opportunities for those who have that capability. What I'd like to do now is talk a little bit more about conflicted remuneration. We've already seen the two types of fees that advisors are charging or are being charged for MDA services. And we have seen that perhaps naively advisors have been building out MDA services in the hope that even if the investment management revenue is paid by the product provider, it won't be conflicted remuneration. Now, this is misguided. The underpinning rule is that regardless of its source, revenue will be conflicted if, because of the nature of the benefit or the circumstances in which it's given, it could reasonably be expected to influence either the choice of financial product recommended, and that includes MDA services, which are considered to be a product, or the financial product advice given. This being the case, the only way the advisor can receive the investment management revenue, even if it's paid by an MDA service provider, is if the client gives their informed consent and direction to its payment. We had an interesting debate about this at the Managed Accounts Conference because theoretically there is legal advice floating around which offers so-called structuring solutions, where a separate entity under a separate ownership provides the investment management services and accordingly doesn't need to disclose the investment management revenue to the client. It's funny that we talk about this because I have only ever seen one example of this advice, and the people I talked to at the Managed Investment Conference said that they'd been told by their clients lots of times that they'd been told by other people that they had legal advice to that effect, but they'd never seen it either. So just be wary if people tell you that this can be done, because I'm not religious by any means, but Matthew had it right when he said, watch out for false prophets. They come to you in sheep's clothing, but inwardly they are ferocious wolves. In this case, the ferocious wolves are the anti-avoidance provisions of the FOFA reforms, which impose a maximum civil penalty of up to $1 million on any company who begins or carries out a scheme for the sole or dominant purpose of avoiding the application of the FOFA reforms. And the sheep's clothing is the fiction of separate legal entities offering the strategic and the investment advice. Sure, this might mean that the entities aren't related, as that term is defined in the Corporations Act, requiring them to in effect be subsidiaries or holding companies of each other, but they are still likely to be associated, which is a far wider definition, encompassing all sorts of relationships, including people who act in concert who are informally or formally associated. These are extremely wide provisions designed for the specific purpose of enabling ASIC to target so-called structuring solutions. So if you are or you know of anyone who's using these type of arrangements, suggest that they obtain a second opinion. This is exactly the type of conduct that I predict that ASIC will be looking for now that the facilitation period for FOFA has ended, and if and when it has some breathing space following the latest round of bank scandals. And what about fee disclosure statements? Do both the strategic financial planning advice and the investment management fee need to be included? Another common misconception, or perhaps it's just wishful thinking, is that the investment management fee does not need to be included. Well, the answer lies in the structure of the fee arrangements. We've already seen that, in order not to be conflicted, the client needs to have given informed consent and direction to the payment of both the advice fee and the investment management fee. So if that's the case, how can the investment management fee be other than an arrangement for the provision of personal advice for which a fee is charged, which is part of the definition of an ongoing fee arrangement? So if the engagement is for more than 12 months, which is the other part of the definition, the fee must be included in a fee disclosure statement. Some people have suggested to me that the investment advice fee and the management component of the fee, or the investment advice and management component, isn't personal advice and therefore shouldn't be included. But the whole point of an MDA service is that the MDA operator is providing individual discretionary management of the client's portfolio. And each 12 months, as Dan will speak to in a moment, the MDA operator must ensure that the client is provided with personal advice to the effect that both the MDA service and the investment program remains suitable for the client. So if that's not personal advice, I don't know what is. Even if the MDA operator is merely administering a model portfolio, that's not what is being represented to the client. So all the fees received by the advisor in respect of the MDA service will need to be included in their FDS, and the client will need to opt into the continuation of the arrangement every 2 years. So now I'd like to hand back to Dan Powell, who's going to talk a little bit more about the advisor lens on managed accounts and advisors' obligations when recommending an SMA.